Here is your chance to own real estate. Commercial real estate, I'm talking about shops, hotels, and all this commercial property, including the offices you see behind you. Remember, as an owner, you're entitled to 90% of the earnings of this new thing called REITs, Real Estate Investment Trusts. You know, they function just like mutual funds, and these companies buy different kinds of income generating real estate, and 90% is given back to you. And the beauty is, you can start with just rupees 500. Amazing, na? You don't need to invest crores of rupees anymore, and you can become an owner. So think about this, whether you're looking at commercial property, REIT, commercial property, REIT, commercial property, REIT, it's the same thing. Guys, REITs are not so simple. I mean, there's an obvious connection between real estate property and REITs, but they're not exactly the same. So in true de-influencing style, today we're going to talk about the good, the bad about REITs, because these guys clearly won't. So hit that like and subscribe, and let's start with point number one. Now, if you buy a physical property, you're basically looking at two types of returns. One is that the physical property itself, the value increases over a period of time. So basically, you buy a commercial property of say 1 crore rupees, and the value of that commercial property goes up to say 2 crores. This is called capital appreciation. The second type of return you're looking at as an investor is the interest payment, or in this case, the rental income. Now, once someone occupies that place, there is a monthly income that tenant pays you, and that is a second source of income. But the problem with this is that, one, you need a large capital to start with, 1, 2, 3, maybe even 5 crores, and two, you have to manage the actual property. Now, this is where REITs come into the picture. A REIT is like a mutual fund. So a mutual fund basically collects money from various investors and pools it in a central location. Now, this central pool invests in equity, in debt, in gold, and other asset classes. REIT functions the same way. It collects money from various investors, puts it in a pool, and then invests it in different income-generating properties. Now, remember, I said income-generating. So this could be a hotel, which is generating some income. This could be a shop, generating some income. It could even be office space, generating some income. This income is collected by the REIT, and according to SEBI's rules, 90% of the income generated, the net, is actually given back to the investors. That's you. So when you buy a REIT, you will log into a broking account, add it just like an equity stock over there, and you can buy it. Now, when you do this, you don't get a flat in your name. You actually get units, just like a mutual fund. And the units represent ownership in that pool of assets. Now, there are two ways you will earn from these units. One is that there's capital appreciation, which means the value of those units can go up. Second, a dividend is paid through the earnings that the REIT generates through these properties, and that's paid to you, just like a physical property. But maybe there is some difference between them, because on the outside, on the surface, it feels like they're both the same. But are they? Let's find out. And REITs have been around for a while. They're not particularly new in the world. From the 1960s, we've seen REITs grown from that to this. And many different companies have actually adopted REITs as an asset in their country, even India for that matter. You can also see the number of listed REITs around the world has just increased from the 90s all the way to the 2000s. So obviously there is some interest from investors to participate in this kind of asset class. Now, if you Google REIT advantages on the internet will tell you get REIT advantages like low ticket size. You can buy all this real estate and not have to worry about spending lots of money, a few thousand rupees, and you're in. Second, you get exposure to a new asset class. Jab dekho equity, debt. You can get real estate with a low amount of money. The third thing is that you get a guaranteed 90% of the returns that they generate into your account. Isn't it amazing? Isn't it beautiful? And property. And you don't even have to manage all of this. Some manager is doing it for you. Hassle-free, easy, low ticket size, best, isn't it? But it's not. There are a lot of misconceptions going around about REITs. And there's nothing wrong with REITs. Globally, and even in India, REITs are fine. I think the problem is of how it's marketed and the perception of people that REITs are exactly the same as real estate on ground. There are obvious differences, and today we'll talk about what those differences actually are, especially in our country, in India. So let's talk about the first misconception about REITs in India. So look at this map. You can see all the REITs over here in America. You can see all the REITs over here on the Asian and the European and this side. India just has 4 REITs. And out of these 4, 3 are just office REITs and 1 is the retail REIT. That's not a lot. Ye to kuch bhi nahi hai. But look globally, there's so many different kinds of REITs. You have logistics, you have hotels, you have all these different kinds. And India neither has number of REITs and it doesn't even have the types of REITs. It's still pretty new. Now, everyone on the internet will tell you REITs brings diversification. If you have equity, diversify out with a REIT to get real estate exposure. Now, this overemphasis we have a problem with. Now, think about this. Ultimately, REITs are an equity instrument. So saying it's just like real estate is wrong because real estate demand and supply has to do more with the location, the metro, the people buying stuff there, a school opening and 1,000 other things. So the exact comparison is not true. Another thing on the internet you'll find is people saying that since you're buying real estate, property to bahut badhiya hota hai and property has no risk. Therefore, REITs have no risk. This is not true. Every asset class in the world, no matter what we're talking about, always carries risk. And with REITs, it's particularly interesting. Now think about an investment company which owns a bunch of commercial properties. It's getting money from you, but it's also debt financed, which means it borrows money from the bank. Here is the risk. As interest rates go up, the cost of borrowing goes up and therefore their profitability goes down. Very simply put, as interest rates go up, their profitability goes down. So, of course, there's risk. And this is completely normal. I'm not saying this is a bad thing, but you should just know what affects REITs. And you can see this in the US. The interest rate environment is high and the REIT index has hit a 14-year low. And even in India, actually, look at this chart. This is the REIT index. It's completely flat. So forget about capital appreciation. It's just not happening over here. In fact, out of the 4 REITs listed, 3 of them are below their IPO price. So there's no capital appreciation so far. Of course, you get those dividends, but well, yeah. Another thing you'll find on the internet is that 90% of all earnings will go to you. There's a problem over here, and it's this. A real estate investment trust is a trust, which means it's a company, and the company actually has to earn a profit, right? Just like any company. There's nothing wrong with it. So every time it earns something, it'll first remove all its expenses. So there'll be employee costs, there'll be electricity, there'll be all these costs a company has. There'll also be a partner share of profits that he'll take. Now, from that, what's left is called the net earnings. And of that, 90% goes to you. So it's not exactly like owning the commercial property yourself. If you owned a shop, you would get to keep everything. In this case, because a trust is managing it, there is a fee, a cost. Now, is there anything wrong with this? Of course not. It's fine, and they must take their due for the work that they've done. It's just that people don't talk about this part. And of course, we have fund of funds. Recently, mutual funds are saying that you can invest in diversified REITs through their fund of funds. Basically, a mutual fund investment is what you do, and that mutual fund finds a bunch of real estate investment trusts to invest not only in India, but across the globe. Now, fund of funds have 2 problems. First, people just don't understand it. They don't understand REITs. How will they understand a fund that invests in REITs? So there's no understanding of how fund of fund works. The second problem is AUM. There is not a lot of money in these funds to actually replicate the index, which is why when you look at the chart over here, there's a huge tracking error. And that's not good. If you're investing in a fund, it should track what it's supposed to track. Why is there so much of deviation? So that's probably a problem in the short term until this becomes more popular. And now is my favorite point, that every REIT cannot be analyzed with a single framework. You can't just put it in some kind of screener and find out which is the best REIT. Let me tell you why. The reason is that every REIT functions a different way. There could be a hotel REIT, there could be a retail REIT, there could be a logistics REIT, and it doesn't end. It could even be a residential REIT. And every REIT is different. Think about it for a moment. If you look at, say, an office REIT, it may have 12 years an average of a lease. But a retail property may function differently because it may not have a 12-year lease. Its lease could be only 6 years. So the difference could be the weighted average of the leases. But that's not where this ends. It could also be how they earn their money. If you look at an office property, it'll basically have a rent pre-decided in the lease agreement. But in a shop, many times, there's a minimum guarantee, and on top of that, there is a revenue share based on sales. So this means that their revenue will be a lot different, and therefore, the analysis for these types of REITs, if it's an office REIT or a retail REIT, will be different. We actually found this while listening to one of the investor calls right here where they mentioned it. And to be honest, this was really surprising. That yeah, it makes sense. Every REIT will have a different way. Now think about it. How will the revenue model of a logistics REIT with warehouses work? Or something like a hotel or residential? We're not saying REITs are good or bad. All we're saying is before you do any investment in any asset classes, understand the nuances. And we thought having a misconception series like de-influencing actually helps because we talk about how simple it is on what you see on the internet and then delve into the depths of it. If you find this useful, please tell us what else should we de-influence. Our team works really hard. Just look at this. We're up since morning trying to figure this out and make this nice thing on commercial real estate. I hope you found it useful. Tell me your experience in the comments below and I'll see you in the next episode.